All right, so this is going to be the last video of this chapter. I'm going to go over some of the smaller questions at first, and then we're going to jump into the bigger one. So PQ3-8, this is related to a prior chapter. We're going to ignore this question. Same with PQ3-9. However, let's talk about it real quickly. Wages paid to employees for work completed will be categorized as which financial reporting element? Be sure to explain why you place it within this element. So, wages paid to employees, that'll be categorized as an expense because remember, we incurred that expense, we consumed it, or we used it up. That's the cost of doing business. We have to pay our employees to get the work done. Simple as that, correct? So that's going to be an expense, and the specific account, even though it's not asking us, the specific account we will record that as would be wages expense. And remember, we're paying our employees because they're helping us earn revenues. We're paying our employees to build our inventory so we can sell it, so we can earn revenues. PQ3-10, I'm going to skip that. PQ3-11, I'm going to skip that. PQ3-12, let's talk about this. Define the account called Accounts Receivable. So receivable is when someone owes you money in the future. Let's just say, for example, we sold water bottles today and they're going to pay us back in 30 days. So we still earned that income. So that gives rise to in revenue. But since they haven't paid us today, we're going to increase an account called Accounts Receivable, which is a future benefit, therefore an asset, because they owe us money in the future. So that's a future benefit. Simple as that, right? So it belongs within an asset because of that reason I just said. Now we're going to go into PQ3-13, which we're going to perform in this big worksheet over here. So it is always important to put yourself in the shoes of the actual question at hand. So you are a lawyer. So you practice law, simple as that. So let's dive right into the transactions. Transaction number 1, you contribute. So the contributions that you made to start your business is $20,000. So simply put, the business is receiving cash for $20,000, which is an asset. So cash is going to go up. And remember, whenever you contribute something to the business, that always gives rise to owner's capital. So owner's capital is also going to go up by $20,000. So cash, $20,000. And then owner's capital, $20,000. Next, you set up a business bank account. The monthly charge will be $14.99 per month, charged on the last day of the month. Remember, this one has no transaction, no entry, because we set up the business account. So this is a business activity, but it doesn't change anything within the accounting equation. So that's very important. Nothing economical in our accounting equation changes, right? We just set up a business account. So at the end of the month, when they actually take the money out of our account, and when we actually use up that service, that gives rise to an asset because our cash is going down, and that gives rise to an expense because our bank expense is going up. So for transaction number 2, we have no entry. Transaction number 3, you pay cash for 3 months of rent in advance. That's very important. So if let's just say, for example, hypothetically, today is September 1st, and we pay for rent in advance on September 1st. We haven't lived there yet, so we haven't consumed or used up that expense, so it doesn't give rise to an expense. However, we paid cash, so cash is going to go down by $3,750. Let's first update that. But now we pay for something in advance, so this gives rise to an account called prepaid rent, because now our landlord owes us the service, and that right there is a future benefit, which is a definition of an asset. So we're going to increase prepaid rent by $37.50. Transaction number 4, we purchase office supplies right away. Stop right there. Office supplies, we know that's a future benefit. That's an asset. Let's just get that out of the way. Then, using your credit card, we already know that credit card is a future obligation, and that gives rise to an accounts payable. So, office supplies increases by $485. And our liability, or specifically accounts payable, also increases by $485. Next, transaction number 5, you paid cash. Once again, we paid cash, right? So if you guys want, if it helps you, if it makes it easier for you, if you know that the first part is cash, let's update it right away. So we paid cash. If we pay cash, cash is being decreased because cash is leaving our personal pocket. We're not gaining cash, we're losing cash. So let's go in and let's decrease cash for 2100. So we're done that now. We know that part at least, right? For 1 year insurance policy. This is very similar to paying for rent in advance. In this case, we're paying for insurance in advance for the full year. So prepaid insurance is going to go up. This isn't insurance expense because we haven't used up that insurance yet. So 2100 for prepaid insurance. Transaction number 6, you registered your business license. Once again, business license is an asset, correct? Our assets increasing. And specifically, business license is going to go up by $60. Let's stop right there. Let's update that right away since we know that. So now we're going to break down each transaction into 2 parts to help us better understand how this works. And the thing is, I feel like when students try tackling it together, they confuse themselves. Even though they know one part, they will mess up that one part because they get confused. So if you write down the first part that you know automatically, at least you'll get half the question right. And you can back yourself up into the part that actually confuses you, correct? So we know that if you pay by a credit card, we're not issuing cash. Credit card means accounts payable. So we've already picked up on that pattern now, correct? So accounts payable is going to go up, increase by $60 as well. Okay, now transaction number 7, you pay cash to your friend to design a website to advertise your services. So once again, we're paying cash. That's very important. You pay cash. Let's get that out of the way first. Cash is decreasing because you're losing cash. So transaction number 7 is negative 1,000. And we're designing a website. So a website is not an expense because the website is going to keep providing you with a future benefit, correct? So we're going to increase website design by $1,000. Next, you pay for 1 month of web services to the website provider using your credit card. So in this situation, first of all, let's talk about the credit card, correct? So credit card is accounts payable. We know that. Let's update that right away. So accounts payable, $20. Done. Okay, now let's talk about the next part of it. So we pay for 1 month of web services to the website provider. So think about it from this point of view. This isn't a prepaid expense because our website's already up and running. It's already designed. Now we need to pay for the web services because it's closely related to the website. So we've actually consumed that expense. So that being said, website expense is going to increase by $20 as well. Next, you advertise in the Mississauga News for 1 month and pay using your credit card. Once again, credit card is accounts payable. Let's go update that right away. So that's going to be for 2260. So we've already advertised, correct? So this isn't a prepaid expense because we've already advertised. It's already been done, correct? So that being said, we've consumed the expense. So we're going to now increase the advertising expense by the same amount. So advertising expense over here is going to be increased by 2260. You advertise in the local Sheridan News paying cash for a full page advertisement. Now we're paying cash, very important. We know that. Let's go in and decrease cash by $500. That's transaction number 10. And by the same token as transaction number 9, our advertising expense is going to increase by $500. Simple as that. Transaction number 11. Now you receive an advance payment from a customer for work to be performed next month. So whenever we receive an advance payment for something, that means we're receiving cash. Cash is coming into our business pocket, right? So cash is increasing. So let's increase cash by $1,200. Okay. So once again, let's read this again. So you receive an advance payment from a customer for work to be performed next month. So we haven't performed the work today, so we haven't earned that revenue. So this doesn't constitute as a revenue, right? However, we have now the future obligation to do something in the future. Remember, whenever we have a future obligation, that is a liability. And the specific account is going to be called unearned revenue. So unearned revenue is also going to go up by $1,200. So now transaction number 12, you provide services to customers for the month. Customer pays you in cash. So in this case, we've actually earned that revenue and we also got the cash for it. So let's increase cash by $4,350 for transaction number 12. $4,350. And remember, we earned that revenue. So service revenue is also going to go up by $43.50. Now the next transaction number 13. So one of your customers has not as yet paid. However, you have provided all the services to the customer already. So this is a little bit of a tricky question, but think about it from a logical standpoint. We provided the service. So we've earned that income. We earned that revenue. For transaction number 13, service revenue is going to increase by $780. Let's go in right away and update that. $780. And now, since they haven't paid us in cash, they owe us money in the future. We just talked about this. That gives rise to an accounts receivable, which is a future benefit to us because we're receiving cash in the future. Future benefit, that's an asset. So accounts receivable is also going to go up by $780. Transaction number 14. You pay for the office utilities, which is electricity, etc., for the month in cash. So cash is going to decrease because it's leaving our pocket. It's leaving our business. It's going to decrease by $172. And since we consume something or use something up, our utility expense is also going to go up by $172. So once again, cash is decreased, negative. Our expense is increasing, so that's why that's a positive number. Transaction number 15. You pay for your business phone for the month. The amount is withdrawn from your business bank account. Whenever they draw amounts from your business bank account, that constitutes as cash. So cash is going to be reduced for transaction number 15 by $192. And then by the same token, this is for your telephone expense. Remember, expense, you need the phone to run your business. That's the cost of doing business. That's the cost that you consumed or used up, correct? So our telephone expense is going to increase now by $192. Now for 16, remember we had that no transaction, no entry, but now the bank actually withdraws the monthly charge from your bank account. So this transaction is related directly to number 2. You set up your business bank account. The monthly charge will be $14.99 per month, charged on the last day of the month. At this point, we didn't use up the service and they took no money out. But now fast forward to transaction number 16. We used up the service, meaning is a cost of doing business now, right? We consumed that cost, and now they took money out. So we're gonna decrease cash by 14.99. And by the same token, we're going to increase our bank charges expense by that same amount. Number 17, by the end of this month, you have used up 1 month of rent. So now we actually consumed 1 month of rent. So we have to do a calculation for this. In transaction number 3, we paid for 3 months of rent in advance for $3,750. So we have to calculate the amount per month. That's a simple calculation. It's $3,750 for a total of 3 months. So we're going to do 3,750 divided by 3 months. So 3,750 divided by 3 months. So that's going to be $1,250 per month. Now, for this specific transaction, our prepaid rent is decreasing by 1 month. Simple as that. So prepaid rent is going to go down by $1,250. And remember, we've actually consumed or used up this expense now. So our rent expense is going up by that same amount. If this is confusing, I highly suggest that you pause, rewind, and listen to it again. But I'll be applying these exact same knowledge for the next few transactions in the context of prepaid insurance. Now, by the same token, we used up 1 month of insurance for transaction number 18. Remember, we prepaid for insurance in advance of $2,100 for the entire year. There's 12 months in a year, correct? So to calculate the monthly amount, we're going to do $2,100 divided by 12 months. So $2,100 divided by 12 months. So our asset or future benefit for prepaid insurance is decreasing by this amount because remember, 1 month is gone now. We used it up. If you think about it logically, this is for 12 months, correct? If 1 month is gone, we still have 11 months remaining, right? And since we used up or consumed 1 month of insurance, that gives rise to an expense. So now our expense is increasing for that same amount. At the end of the month, $175 of the supplies were still on hand and the remainder has been used up. So remember, we have supplies of $485. And they're saying that $175 were still on hand. So think about this logically. So supplies and stuff like paper, pen, stapler, stuff like that. Let's just say we put all of our supplies in one drawer. So that drawer has $485 worth of supplies in there. And let's just say at the end of the month, we open up that drawer and we count how much is remaining. There's $175 remaining. So the difference is what we must have used up, correct? So bought $485. Remaining, once again, is $175. That means we must have used up the difference, correct? To calculate the difference, we're just going to take the 485, subtract it with the 175. This is what we used up. So this is what we consumed, used up. Remember, that constitutes as an expense. So for number 19, office supplies expense is going to be for $310. And since we used up this amount, our office supplies is going to decrease by $310 as well. So at the bottom here, I already have preset formulas to calculate the totals in each account. If you look at this for office supplies, just focus on office supplies, please. So office supplies. Once we take the 485 and we subtract the 310, we get 175, which is what is left on hand at the end of the month. Now for number 20, we need to calculate the income tax expense again. So you know you will have to pay income taxes on your income. There's no way around that. Remember, one of the external stakeholders is the Canada Revenue Agency, which is a CRA, and their whole purpose is to collect taxes from us, right? So to calculate this again, let's do a quick calculation. We've talked about this already. Let's do it again. So remember, revenues less expenses gives us profit before, or income. Profit and income is the same thing, income before taxes. So we know that revenues is this over here, and expenses is going to be a product of website expense plus advertising expense plus office supplies expense plus utilities expense plus telephone expense plus insurance expense plus rent expense plus bank charges expense. So I have preset formulas in here already, but when you're doing this question, you would have to calculate all these balances on your own, right? So for example, to calculate the balance for accounts payable, we're going to simply do 485 plus 60 plus 20 plus 2260 to arrive at 2825. For advertising expense, 2260 plus 500 gets us this. If we have a negative number, then we're going to subtract it. Simple as that, right? So once we do this, we're going to take the revenue, subtract the expenses to arrive at 236. Then remember, income tax expense equals the income before taxes times it by the tax rate. So in this case, it's simply going to be the 236.01 times the 25%. It's going to be $59. All right, so we're going to increase income tax expense by the income tax expense we calculated over here. Then by the same token, since we now have a future obligation to pay the CRA in the future, we're going to increase income tax payable by that same amount. So this question is a little bit more complicated. Much more accounts are involved. So practice is key. Once again, do not memorize. Please think about it logically.